Did you see the movie The Big Short? The Big Short?
Actually, I haven't.
You didn't see that? Yeah. They tried to explain like the 2008 mortgage crisis, what caused it, how some people made some money, and it was a little bit of a documentary fiction, you know. But the movie, I think it's a good example of where, when they tell us the truth, it's to cover up a bigger lie. And so it was partial truth, the story in that movie about 2008. Because you say, what caused 2008 crisis? Derivatives, they say. Leverage, greed, all right? Mortgage debt.
Mortgages.
Yeah, and options and crazy derivatives they were using. But that's not the cause. You know, that's more of a pretext to kind of explain it to the layman. And then they might say Lehman Brothers caused it, when Lehman Brothers blew up. But that's what the start was. So when we differentiate and discern start, pretext, and cause, the true cause in my mind started in 1999 with the repeal of Glass-Steagall Act. Okay?
You mentioned that.
You know the Glass-Steagall Act, right? It was that old, it was laws, like prescriptions that came out, laws that were designed after the Great Depression, the investigation, you know, in the 30s. And one of the key rules from that act is banks cannot, by law, put debt on their balance sheet as an asset. They cannot call debt reserves, okay?
And then loan against debt.
And then loan against a fractional, like, you know, next thing you know, you're levering to hell. And what happens then is let's say mortgage debt is called guaranteed. And because it's guaranteed, why is it guaranteed? Because they said real estate has not gone down in America in history. Therefore, it only goes up. So that's their logic, you know, and okay.
In theory, but, you know, how long can it go up 20% a year?
But it's only their sample size. You know, real estate is just like any asset. It rises and falls, of course. You know, during the Great Depression, real estate completely collapsed. You know, totally collapsed. You read the books called Grapes of Wrath, you know, and the family from, where were they from, Nebraska or something, or Oklahoma, and Okies? They lost their farms. They had to go, you know, and so there was, no, real estate definitely can go down, especially if the financial crisis hits. So, no, it's just a faulty lie to trick people and trick the government to say American real estate is guaranteed, and therefore we call it a AAA bond, okay? And if it's AAA, then we are allowed by law now, after the repeal of Glass-Steagall, to put mortgage debt on the Lehman Brothers balance sheet and call it reserves as an asset. And so it's that loan for mortgage is the same, treated legally the same, and accounting-wise, as a cash deposit. So it's like a customer comes in and gives you the bank. And what you said is, as the balance sheet rises with more debt given out to mortgage, what happens? The bank's balance sheet rises, they can lend more. So, and what do they lend for? More derivatives, more mortgage. And so it's like a cycle. Next thing you know, the balance sheet of Lehman, or a lot of those banks, was just loaded with commercial debt. And not only was it real estate debt balance sheet, so not that much cash on the balance sheet, mostly debt. Not only that, by law, the government could report it as, the banks would report the mortgages and the derivatives at full value, 100%. It's called mark to market. They would mark it to par. If the mortgages were going down in value because customers were defaulting or disappearing, or the whole thing got too expensive, the bank would still call that 100% valuation. Even though in reality, maybe this debt that they own on their asset side of the balance sheet called reserves is much less. So they were able to call it par, not marked to the value of the market. And so what happened is, when the 2008 crisis started to hit, and the low-end borrowers of real estate, the worst loans, the most corrupt, the poorest, borrowers, purchase of a house, they would default first because they're the weakest, okay? And so as the defaults were happening in real estate, now the bank has no choice. They have to write it down because the bond defaulted. And so basically the balance sheet of Lehman Brothers and the other banks was collapsing. Not much different than, let's say, how in It's a Wonderful Life, where the customers all line up outside and they pull their cash. It's the same idea as a bank run, but it's just the debt's falling apart. And that's why they needed bailouts. They needed bailouts to survive. They didn't need bailouts and keep their jobs and keep their bonus. They didn't need bailouts because the American needed it, and that's a whole different story. But they got banks, and so the bailouts basically pumped up their balance sheets that were collapsing because of debt. You understand? So that's how the 2008 crisis started. Hillary Clinton also did in that act, and Bill, I assume, was involved. But Goldman Sachs had a big party for her and said, you gave us student loans on a platter in 1999 because the Clinton administration made undischargeable in bankruptcy student loans. And now they go to, if I am a student and I borrow a bunch of money to go to school in some damn college that teaches me to hate the country and despise men so that I'm completely unemployable because I'm spiteful and I think the world is an awful place and turn me into a Cain thinker where everybody's out to get me and rip me off and screw me over and I've got tons of student loan debt to prove it, then I know what I'm talking about. That, if I die, my parents have to now pay off the debt.
Student loans and taxes.
Yeah, that's pretty mean. But Hillary Clinton, primarily, and the Clintons did that. And they're friends with the bankers more than anyone. Democrats are really close with the banks. Of course, they're the same people, same party, ideological part of the same party. Racially, also very connected. So, anyway, this is how 2008 happened, more or less.